When we look at the judgment itself, we can see that it's broken into a couple of separate points, right? First, there's additional actual findings, and we're not going to deal with a lot of that because we will deal with it as we go through the judgment. And then it talks about the credit rating evidence of the credit ratings of the different parties, and the judge makes a number of very interesting observations about implicit parent support that we'll deal with. Funny thing is, he never refers to Chapter 10 of the OECD guidelines, but we'll deal with it later again. And then they talk about DCM evidence, and DCM is the US debt credit markets, which they are referring to. And the question here was, is the US debt credit market, is that a comparable for this LNIA agreement? Yes or no? And then finally, the judge comes to law, and it deals with a number of other issues that we will look at, such as parent guarantees and the different amendments of the agreements. So let us have a look at what they said. And first of all, just to point out, there's a number of names that you'll see coming up, and just so you know who acts for whom. The taxpayer called Dr. Chambers, and they called Mr. Chigas with regard to DCM measures. And then the commissioner called Mr. Weiss and Johnson. And it will be fair to say that in general, it seemed like the judge preferred the taxpayers' expert witnesses, even though it still so happened that the taxpayer lost the case based on Mr. Johnson's calculations. So let's see what was said. First, with regard to implicit support, following the acquisition of SOPL, SOPL's credit rating was upgraded by S&P and Moody's to A+ and A2 respectively. Now, I notice this here because the court doesn't say why its credit rating was upgraded, but clearly the change in ownership had a consequence, and SOPL's credit rating wasn't downgraded, what it was upgraded, right? And one would assume that that has something to do with implicit support, but the court never says so. And then there's a big discussion about implicit support, and it goes into quite a lot of technical detail, which is interesting. It says both S&P and Moody's published specific guidance concerning the need to critically assess the willingness and ability of the parent to provide implicit support. While S&P's guidance identifies 13 factors, we'll look at those in a moment, Moody's provides some examples. The rating agencies specify that the step up in assessing implicit support, parental support for a subsidiary is the first step is the standalone rating of the subsidiary. The next step is to raise this to reflect the expected support of the principal, right? And the most critical issue in assessing parental support is what will happen should the subsidiary be in financial distress. The rating agencies determined that a bottom-up approach, where you look at the subsidiary and then at the parent, rather than looking at the parent, can it do it and then will it do it? The bottom-up approach does a better job of capturing this what would happen if exercise, since it requires its analysis to specifically consider those stress conditions. In other words, what are they? What causes the stress, etc., and the factors which evidence potential support in those circumstances. The agency's processes have two components to its analysis: willingness and ability to support. In other words, it doesn't only help that the parent is willing to support the subsidiary, it must also have the ability to do so. So, and then they say the joint credit rating report, which the two experts produced together, sets out the following extract from page 100 of S&P's Corporate Ratings Criteria 2002, and this shows the 13 factors to consider, right? And it says no single factor determines the analytical view of the relationship with the business venture in question. Rather, these are several factors that, when taken together, will lead to one characterization or another. And then you need to look at things like strategic importance, right? I mean, how important is the subsidiary to the parent? Percentage of ownership. The management control, is the parent already controlling the subsidiary? In other words, is it jointly liable when things go wrong? The shared name, if a subsidiary has a completely different name, it might be easier. A lot of this comes back in the new chapter 10 of the OECD transfer pricing guideline as well, whether they are domiciled in the same country or not. Common sources of capital, financial capacity to provide support, in other words, not only the willingness but also the ability to do so. The significance of amount of investment, how much money has been put in there and what was it used, right? The investment relative to amount of debt at the venture or project. The nature of the other owners, whether they're strategic or financial, and what their capacity is. The management stated posture, whether they believe in support and whether they will support or whether they won't. A track record of the parent firm in similar circumstances, and the nature of potential risks. So these are the things to consider, and the different experts did so. Mr. Weiss, which operated for the Australian tax authorities, made a number of good points, I think. He said, in Mr. Weiss' opinion, it is that Singapore's Singtel has the willingness and ability to provide implicit support to STI, and that it would not be affected by the presence of the 5.2 billion of STI debt as third-party debt raised by STI as part of the $14.2 billion purchase of SOPL. This recognizes circularity of the financing at STI. Essentially, the 5.2 billion LNIA, assumed to be third-party transaction, would be used to repay a portion of the cost incurred by Singtel in its acquisition of SOPL. The outcome would not change, would be no change to Singtel's ratings. In other words, what the expert says here is, well, you know, this is intercompany debt. I already borrowed debt to pay for this. So if I have to pay this, it'll essentially be paying the debt that I owe already, right? An overriding consideration in Mr. Weiss's assessment relates to what he describes as the fact that in making SOPL acquisition, Singtel understood the enormity of its decision. And he mentions a couple of points, of which I take what I think to be the most relevant. A, the support of its major stakeholder, which is Temasek, the manager of the Singapore Government Investment Fund, and therefore Temasek's 100% shareholder, the Singapore government. Singapore liked this investment, and one would assume that Singapore has been discussed, has been approached to talk about this before they went ahead and did it, right? The opportunity to own 100% of a major telecommunications company like SOPL, the number 2 telecommunications company in Australia, and to immediately establish its second telecommunication hub in Australia as one of the 4 major telecommunication hubs in the region. In other words, not only that SOPL make Singtel great in Australia, it made it great in the Asia Pacific region, right? Mr. Weiss refers to the views of S&P and Moody's with respect to the SOPL acquisition. Each agency stated that it considered the importance of the Australian investment as key to Singtel's growth ambitions and strategic direction. So Mr. Weiss clearly thinks that Singtel would have supported SATL if it needed any support, and he lifts up the rating. I think Singtel had a AA- rating, and SOPL or STI was quite below that, but it actually lifted it up by 6 to 8 notches to become just below the Singtel rating itself. However, the taxpayer's expert witness, Dr. Chambers, is much more negative. Dr. Chambers' overall assessment of this topic can be summarized as follows. Dr. Chambers expresses the view that it is clear from both agencies' guidance that the bottom-up approach is to be applied in assessing implicit support. And you got to say Dr. Weiss very much looked from Singtel's perspective, right? But I think he had reason to do so. And then he says, there is no historical experience on which to judge what Singtel might do in the event of distress of FCA, right? Further, uncertainties as to whether Singtel's direct major shareholder, the Singapore government, would approve of propping up an offshore subsidiary. It is unclear as to whether Singtel would have the means to provide significant support on a timely basis, right? So what it says is, you know what, I mean, at the end of the day, this will still be the government of Singapore indirectly financing a loss-making business in another country, and will you do it? And therefore, Dr. Chambers says the guidance provided by both S&P and Moody's indicate that one must be cautious and seek clear evidence of such support rather than simply inferring it. And he only upgrades their credit rating by 2 to 3 notches. And the question now is, what does the judge do? And the judge says, on balance and with respect to Mr. Weiss, I prefer the views expressed by Dr. Chambers. First, he liked the way that Dr. Chambers presented himself. And then he said, in terms of other reasoning, first, Dr. Chambers appears to have adopted a more cautious approach than Mr. Weiss to the assessment of implicit support. This seems to me to better reflect the S&P criteria and the Moody's criteria for assessing implicit support. And he also talks about, bottom up is better than top down. So this is what was said about implicit support. I think it raises interesting points and questions. I also can see how the judge very easily could have followed Mr. Weiss's example, and I wouldn't be surprised that should ever it be needed, that Mr. Weiss would be proved right in future. And then we come to the DCM as a comparable, and the DCM, as I said before, is using US debt capital markets as comparables. And Style, the taxpayer, made a couple of statements here. It said, it is now common ground that a company in the position of Style in June 2002, when it acquired Sopel, could have borrowed $5.2 billion without a guarantee. It is also common ground that the most economical and likely one source of debt in the amount of $2.5 billion for a term of 10 years for a party in the position of Style would have been the US debt capital markets in the form of a new issue transaction, right? Style's primary case is that the actual cost of the borrowing to Style under the LNIA was not greater than the cost that a party in Style's position might be expected to have paid to an independent party acting wholly independently so as to achieve the same cash flow advantages which Style actually achieved. So that's quite a bold statement, and let's see what they make a few more, but then we'll see how they came to it. Style makes the following submissions. A, assuming the actual transaction was a traditional DCM borrowing from deferred and capital interest, Mr. Shiga's calculations results in the same interest outgoing, including the 10/9 uplift, as was actually paid over the period, namely 4.9 billion or 5 billion, right? I mean, you borrow 5 billion and in 10 years you pay 5 billion. Mr. Shigas then determined that had Style actually borrowed in a DCM transaction with deferred and capitalized interest over 10 years, the credit spread that might be expected to apply was 400 basis points. It follows from Style's profits in 2010, 11, 12, and 13 were not less than those that might have been expected to if it did the DCM, right? And then we look a little further into Mr. Shigas' analysis, and this can be summarized as follows. He goes through a number of scenarios. He says the effective rate under the actual NRA was 144 basis points, right? A DCM transaction with a parent guarantee from Singtel with no guarantee fee payable by Style would have had a credit spread of 205 to 250 basis points. So he says, that is already more, right? A DCM transaction with a parent guarantee with a guarantee fee would have been 300 to 360 basis points, and a DCM transaction with no parent guarantee would have been 400 basis points. So he basically says, you guys have saved a hell of a lot of money because you paid 144 instead of 400, and this is also the taxpayer's defense. Mr. Shigas expresses the view that the total cost of the debt to Style in the scenarios presented in B, C, and D above are all above the actual LNA effective credit spread of 144 basis points. Therefore, he concludes no profits were forgone and no profits could have been expected to be accrued by Style. And now the question is, yes, but are these DCMs comparable, right? Mr. Johnson, which was the government witness, expresses the opinion that an estimated 1.23 billion in profits should have accrued to Style if it had not borrowed under the provisions of the LNA as amended from time to time and had instead borrowed from the bank and DCM. So in other words, Mr. Johnson says, no, you could have borrowed much cheaper than these 400 basis points, right? And now we come to what the judge thinks, right? I mean, are the DCMs comparables or not? And the judge says very early in the decision, the judge summarizes the decision. He says, the principal difficulty with Stey's approach is that it departs too far from the actual transaction and the characteristics of the parties to the transaction. It did not involve a DCM bond issue. Further, what he says here is this involves a company buying shares against debt. It did not involve a DCM bond issue. Further, I consider there to be significant differences between the terms of the LNIA and the terms of the DCM bond issue. And to be honest, I find it difficult to follow the judge in what the differences are. But we look at what he talks about and what the taxpayer talks about to get some idea of what's going on. With regard to Mr. Shiga's evidence, the judge says, insofar as Mr. Shiga has in his first report addressed conditions operating as between Stey and Sai, he addressed only the conditions in the LNIA as distinct from conditions between Stey and Sai in their commercial or financial relations, right? Which is part of what's required by Article 6, which I assume is the normal Article 9 in the Singapore double tax agreement. This is not a criticism of Mr. Shigas. It is a consequence of the question he was asked to address. So he didn't do anything wrong. He was simply answering a different question as to the question whether the DCMs were comparables, right? Insofar as Mr. Shigas expresses the view that the overall structure of the LNIA is consistent with the bond issued in the DCM, I have difficulty in accepting this view. In particular, I have difficulty in accepting that the benchmark concept and the associated clauses are consistent with the DCM bond issue. And the benchmark issue that he refers to here is in the second amendment. They said, you know what, you're not going to have the interest accrue to the principal automatically now year after year until Sopel has a positive cash flow. No. We're going to benchmark Sopel's performance, and when Sopel is ready, we will start accruing and paying interest. And for that deferral of interest, you have to pay the 4.75% extra, right? And the judge says, I don't think a benchmark like that would happen in a public DCM market. Further, the terms of the LNIA regarding the giving of variations notices do not appear to be consistent with the DCM bond issue. And this is when things become payable, right? To be fair, I do believe that one of the experts have said that on the DCM markets that you can get benchmark DCMs, but that they are few and far between. And then the judge goes on to say, moreover, by addressing the LNA as amended, Mr. Shigas has not directly addressed whether the changes effect by the Second Amendment might be expected to have been made if partners were independent. He just said, you know, that the Second Amended LNIA was, well, you could have done on the bond market as well. And the judge says, yeah, but hang on, I mean, you changed the situation, right? And it's the change in situation from the original LNIA to the First and the Second Amendment. Would a party have agreed to that if they already agreed to the original LNIA? Because clearly for them the amended LNIAs were worse. They now had a definite payment term and they had a 4.75% additional premium that they had to pay. A second difficulty with Mr. Shigas and thus STIA's approach is that it involves the calculation in hindsight of the effective credit spread of LNIA, rather than an approach which focuses on what independent parties in the position of Sai and Stey dealing independently with each other might have been expected to agree to in June 2002. So what he says here, I think, is he says, you know, you've simply looked at the historic data and came to the conclusion that the difference would have been 400 basis points. But we didn't know that in 2002. You should have made your calculations and estimations as if you had no idea of what's coming, right? And not use hindsight to afterwards confirm your pricing So let's see what else the taxpayer argued. And he said, Stey submits that there are 4 fundamental flaws with the Commissioner's approach. In summary, Stey submits the first flaw is that one must hypothesize a bridge loan of 5.2 billion for 9 months without the ability to defer and capitalize interest and a new 5.2 billion term loan being negotiated in March 2003 for 9 years and 3 months. And I think this had to do with the cash flow problems of Sopel, but I'm not quite sure what the detail of this is. The second flaw is the erroneous conclusion that implicit non-binding parental support would be provided by Singtel and indirectly by the government of Singapore. So we've already talked about the implicit support. The third flaw is his assertion that an independent borrower in the position of Stein might not have been expected to have fixed the interest rate under the LNA, and this is the third amendment. And the fourth flaw relates to the withholding tax gross up, and there's not a lot spent on this. The documentation said that the taxpayer should gross up if there is withholding tax and pay it for itself, rather than have the creditor pay the withholding tax. I think the taxpayer was right in that. The judge rejected it without spending a lot of wording on it. But let's look further into the judge's arguments in coming to his final conclusion.